Hi everyone. Good morning, good afternoon, good evening, or whenever you watch this video. First of all, thanks for the opportunity. We are from the group 3, with the member consists of Lazwardi Imani, Febriani Sarwinda, Bertalia Permata Putri, and Dona Marsandri. At this time, we will present to you about the Comparative Financial International Accounting. Without any further ado, let's get started.
Assalamualaikum warahmatullahi wabarakatuh. Thanks for the opportunity. So I'm Lazarji Imani, and right now I'd like to introduce about the accounting in America or United States of America. But first, I'd like to explain about the America and Asia as a whole. So the United States has the largest economy in the world and is home to larger multinational companies than any other country. Japan has the second largest company in the world and is also home to many of the largest businesses in the world. These two countries are founders of the International Accounting Standards Committee, or now is called the International Accounting Standard Board, or ISB, and have a major role in directing the ISB agenda. China is the largest and most populous country in the world. Companies from all over the world are eager to do business there. China is moving to a socialist market economy, a planned economy with market adaptation. Accounting development are an important part of structural changes in the Chinese community and the Chinese economy. Mexico and India are capitalist countries, but with central government intervention and major industrial ownership by the government. Historically, the economies of Mexico and India have been somewhat closed to foreign investment and international competition. This has now changed as the two governments privatized industrial ownership and opened themselves up to the global economy. Accounting standard setting both in the United States, Mexico, Japan, and China are committed to combining their national generally accepted accounting principle or GAAP with IFRS. So, national financial reporting standards will remain in these countries. Even though they are aligned with IFRS, India, on the other hand, plans to adopt IFRS as a domestic reporting requirement, thereby eliminating Indian GAAP. Okay, next is still the explanation about the United States of America, but about the accounting system in USA. The accounting system in the USA is regulated by a private sector, which is a Financial Accounting Standards Board, or FASB. Until 2002, the American Institute of Certified Public Accountants, or AICPA, set auditing standards. In that year, the Public Company Accounting Oversight Board, or PCAOB, was established with broad authority to regulate audits and auditors of public companies. PCAOB is a private organization overseen by the SEC, or Securities and Exchange Commission. Next is the explanation about the accounting rules and practice in the United States of America. The United States system does not have a general legal requirement for the publication of periodically audited financial reports. Companies in the United States are formed under state law and not federal law. Each state has its own company law. In general, it contains the minimum requirements for keeping accounting records and issuing periodic financial reports. Many of these laws are not strictly enforced, and reports provided to local agencies are often not available to the public. Accordingly, the annual audit requirements and financial reporting realistically exist only at the federal level as determined by the SEC. The SEC has jurisdictions over companies listed on US stock exchanges and companies traded over the counter. The SEC has the legal authority to set accounting and reporting standards for public companies but relies on the private sector to set standards. The SEC works with the FASB and exerts pressure when it believes that FASB is moving too slowly or in the wrong direction. Sometimes the ACC delays or rejects statements or has its own terms. Because the ACC is an independent governing body, Congress and the President have no direct influence over its policies. However, the five full-time SEC commissioners are appointed by the President and confirmed by the Senate. The SEC only has powers that Congress has granted by law. The FASB was founded in 1973 and as of June 2009 published 165 statements of financial accounting standards or SFAS. The purpose of SFAS is to provide useful information for current and potential investors, creditors, and other parties making investments, credits, and similar decisions. The FASB has five full-time members representing accounting firms, academia, corporations, and the investor community. Board members must sever all economic and organizational relationships with employers or previous ownership in order to serve. The FASB's use of a conceptual framework is an important feature of accounting standard setting in the United States. Statement of Financial Accounting concept establishes the fundamentals of financial accounting and reporting standards. In 2002, the FASB and ISB formalized their commitment to convergence by signing the Norwalk Agreement. Under this agreement, the two boards pledged to remove existing differences between their standards and coordinate a future standard setting agenda so that key issues are dealt with together. The commitment to convergence was reaffirmed in 2005, and convergence is scheduled for completion in 2011. So next is about the financial reporting in the United States of America. So the annual financial statements of a large US company includes the following components. So the first is management report, second, independent auditors report, third is primary financial statements, which include income statement, balance sheet, cash flow statement, comprehensive income statement, and change in shareholder equity report. Fourth, management discussion and analysis of results of operation and financial condition. Fifth, disclosure of accounting policies that have the most critical impact on financial statements. Six, notes to financial statements. Seventh, 5 or 10-year comparison of selected financial data. And the last is selected quarterly data. Consolidated financial statements are required and published. United States financial statements usually do not contain parent company specific reports only. The consolidation rules require that all controlled subsidiaries, for example, ownership of more than 50% of the voting rights, be fully consolidated, including company with non-homogeneous operation. Interim or the quarterly financial reports are required for company listed on the major stock exchanges. These reports usually contain only brief unaudited financial report and brief management comments. Next is about the measurement accounting in America Union. Accounting measurement rules in the United States assume that the business entity will continue. The measurement of the accrual basis is broad, and the transaction and event recognition rules rely heavily on the matching concept. Consistency requirement emphasize uniformity of accounting treatment of similar matters in each accounting period from one period to the next. If a change in practice or procedure occurs, the change of its effective should be disclosed. The United States relies on historical cost to value both tangible and intangible assets. Revaluation is allowed only after a business combination. Multiple declining balance and straight line methods are allowed. The estimated economic usefulness determines the depreciation and amortization period. All research and development costs are normally charged as incurred. The LIFO, FIFO, and average cost method are allowed and widely used for the determination of inventory prices. LIFO is well known because it can be used for income tax purposes. However, if LIFO is used for tax purposes, it must also be used for financial reporting purposes. Marketable securities are valued on the marking unless classified as held to maturity and are valued as historical cost. When a financial lease is in the substance of a property purchase, the property's value is capitalized and the associated liability is recorded. The cost of pension and other post-retirement benefits is recognized during the period in which the employee benefits, and any unfunded liabilities are reported as liabilities. Contingent losses or liabilities are accrued when it is probable that they occur and the amount can be reasonably estimated. Profit smoothing techniques are not allowed. So that's all about my explanation, and the next explanation will be delivered by my friend. Thank you.
Okay, thank you for the opportunity. My name is Febriana Sarinda with student ID 218. Now, in this presentation, I want to continue my friend explanation. So in this slide, I want to tell you and I want to explain about the Mexican financial accounting system. So as we look at the screen, that the Mexico has a large free market economy and it is relatively stable, guys. And although like most countries has been buffeted by the global pandemic in 2020 and its gross domestic product or GDP of nearly in 1.3 million US dollar was ranked 15 globally by the World Bank in 2019, and it is the second largest economy in Latin America. And then for the next is because of that, so company prefer to raise the capital through debt rather than equity. Why? I think the reason is why company might select they use debt rather than equity finance include a loan doesn't provide an ownership stake and so does not cause dilution to the owner's equity position in the business. And if we compare with the debt, debt can be a less expensive source of the growth capital as the growth capital in a company is growing at a high rate. So the Mexican commercial bank are still the most important supplier of fund to the business in now. And then the next is the Mexican business sector was largely family owned. So the Mexican family business enjoy public protection, subsidies, and the traffics of wealth until the 1980 when globalization and free trade brought and it entered their dominant position within the economy. So it given the dominance of family companies, especially in the Mexican. And in Mexico, most business organizations, large and or small, are family-run units. So to say that Mexico falls under the low trust category of culture is an understatement. So some would even go so far as to say this is a country of no trust when it comes to business association. And for thus, the requirement of trust over competency are as acute in Mexico anywhere in the world. Okay, that's all. And for the next slide, we will discuss about the Mexican accounting regulation and practice. So, in accounting standard issued by Council for Research and Development of Financial Information Standard, and these international accounting standards were issued by the Attendance International Accounting Standard Council and endorsed and amended by the International Accounting Standard Board or IESB. The IESB will also reissue standard in this series where it considered inappropriate. And because of that, all of the company incorporated under Mexican law must appoint at least one auditor to report to shareholder about the annual financial statement. And for the next is all of the company in the Mexico, so that listed on the Mexican Stock Exchange must submit annual consolidated financial statement audited by a Mexican public accountant either to the stock exchange or to the National Banking and Securities Commission. Next slide. In this slide, we will discuss about the Financial Report Mexico and also the comparative consolidated financial statement. What kind that we should prepare in comparative consolidated financial statement. So, for the Finance Report Mexico, as we know in the slide is written, a Mexican corporate fiscal year must coincide with a calendar year. So, a Mexican holding company may obtain an authorization no later than 15 August of the prior year for which the integration will apply to compute income tax on an integration regime. But each company of the group is responsible for filing and paying the corporate tax individually. Certain requirements should be observed to qualify under this regime, and particularly if 80% or more of the holding company's share are owned by a foreign corporation. So, before I going to the next, we should know that all of the company incorporated under Mexican law must appoint at least one statutory auditor to report the stakeholder in their annual financial statement, right? So necessities for preparing financial statement and having them audited differ by type and size of the business. So statutory auditor do not have to be public accountant, but when a firm uses independent auditor, a member of the auditing firm frequently acts as statutory auditor. So company or consolidated group that meet certain size criteria must file a tax compliance audit report every year with the Federal Tax Audit Department of the Ministry of Finance. So the report consists of audited financial statement, additional schedule, and a statement by the auditor that no irregularities were observed regarding compliance with tax laws. So this audit must be done by a Mexican public accountant. And how about the part that we should prepare to make a comparative consolidation financial statement? So we can look at the screen, guys, that there are many financial statement that I think you already know that the first is balance. Balance here means that the financial position, and then there is also income statement, cash flow statement, reports and changes in shareholder equity, and also the notes. We have five financial statement to in comparative consolidated financial statement. Next, we should know about the measurement Mexican accounting. So, as we know that there are many accounts that we should have a measurement in the Mexican, for example, the intangible asset. So the intangible asset are amortized over their useful life, usually not more than 20 years, unless they are indefinite. So in which case they are not amortized, but will be subject to annual impairment test. And for the second part is about the research. The research core are changed as incurred while the development costs are capitalized and amortized once the technological feasibility has been determined. And what the third? The third is about the lease. So the lease are classified as a financing or operating lease financing who transfer substantially all the benefit and risk of ownership of the asset capitals itself, and temporarily the list from operating list charged to the income statement. Okay, I think the third of this account it should be the important thing in the measurement Mexican accounting. Next, we should know about the Japanese financial accounting system. So as we know at the screen that there are many kind of laws that happen in the Japanese financial accounting system. For the Japan's generally accepted accounting principle of, or we also can call with HGAAP. So are issued by the Financial Service Agency or BCA and Accounting Standard Board of Japan. So it is one of the four sets of accounting standards listed companies in Japan currently choose from to use to file their consolidated financial statement. And also there are many kind of interested I think principle or model in Japan. For example, the business model Keiretsu. So this was transformed when Japan carried out the structural reforms to overcome the economic stagnation that occurred in the 1990. So the financial crisis that followed the eruptions of Japan's let me say that is about the bubbles economy. So also a review of Japan's financial reporting standards. And as the Japan's financial market reform for the globalization accounting standard board of Japan, and also introduced the big bang accounting reform in late 1990s. And how about the next system or the next financial system in Japan? So the next is about one of the original goals of Big Bang accounting reform is to promote the participation of foreign and domestic investors in the Japan's securities market by what? It is by establishing a disclosure system equivalent to international standards. So I think that's all about my explanation. And for the next explanation in the next topic will be explained by my friend. Thank you.
Hi everyone, thanks for the opportunity. Here I'm Berta with student ID 440. We'll continue the presentation. So here I'm going to explain to you about the regulation and the implementation of accounting in Japan. So in the accounting system in Japan, the national government has a significant influence in the accounting system. That is, which is in the Japan, the accounting regulations are based of three laws that are called triangular legal system. That are consist of company law, and the second is the security and exchange law, and the third is the corporate income tax law. First, for the company law itself, the fundamental principle of this law is to protect the creditors and the shareholder. And the second is security, or let's say sell law. So the main purpose of this law itself is to provide an information about for the consideration for the investment decision making, like that. And the corporate income tax law is calculate based amount of the company law itself. And next here, I'm going to explain to you about the financial report in Japan. So in Japan, for the company that are founded based on the company law, they are required to prepare a financial report based as follows. First is the balance sheet. The second is the income statement. The third is report of equity changes. The fourth is business report. And the fifth is schedule support. And also for the company that are listed in the capital market that are based on the KEL law, the required financial report is also the same, number one until 5, but there's additional report they are required to prepare also a cash flow. It's cash flow for the KEL law only. And the next. And here I'm going to explain to you about the measurement of accounting in Japan. So the measurement of the inventory in their system, that inventory must be valued at cost or NRV, or net realizable value. And for the inventory method itself, The inventory method that acceptable in the Japanese accounting system is FIFO, and average. And the most popular method that are using there is the average method. While for the research and development costs should be charged as incurred, and the financial leases should be capitalized and amortized while operating the leases are charged. Okay, next here we're gonna discuss about the accounting system in China. So the main characteristic of accounting system in China today itself was stems from its established People's Republic of China in 1949. That are the state is control the ownership of the production. Its mean include all the production process and also the distribution process. All right was controlled by the state, and the purpose of this accounting system itself is to serve the state needed for economic planning and control. And the uniformity of the accounting system, it contains all the accounting rules that are mandatory for the state-owned companies throughout the country. And for the financial reporting in this China accounting system is focused on the stewardship and the accountability. And actually, this Chinese economy system today is the best as the best description of the economy hybrid. That's mean where the state is control the strategic commodities and the industry, while the other industry are governed by the market oriented system. So here we're gonna discuss about the Chinese accounting regulation and practice. In the Chinese, the accounting regulation and practice is the one who makes or formulating the regulation is the Ministry of the Finance that are still being watched or controlled by the State Council. And the accounting standard and the promotion that are consist there is the first that the Ministry of Finance the publish the accounting standard for the business enterprise, or also called as ASBE, that at the time was still a conceptual framework designed to guide the development of new accounting standard that will ultimately align the domestic practice as well align the Chinese accounting practice with international accounting practice. And in 1998, the Ministry of Finance, who is responsible for developing the accounting standard, published a China Accounting Standard Committee, or CASC, and in 2006, the Ministry of Finance finally published a accounting standard for business enterprise, or ASBE, that are recently published recently published ASBE. It should apply for all the Chinese company except for a small company. And for the there are also regulation called CSRC that are a China Security Regulation Commission that regulates the two Chinese stock exchange. And this law is established the regulatory guidelines, formulate and enforce market rules, and authorize the new public offering and shares. That's all for the presentation. That's all for my presentation today. The next material will be explained by
Okay, thank you for the opportunity. My name is Dona Barsari with student number 441. Here I will explain about China financial reporting. In China, the financial reporting consists of 5 kinds. The first is balance sheet, the second one is income statement, the third is cash flow, the fourth is capital statement, and the last is notes. And in China, additional statements are required to disclose on asset values, changes in capital structure, use of profits and business, and also geographic segments. Their records include their policy statements and discuss matters such as contingencies, important post-balance sheet events, and related party transactions. Management discussion and analysis is needed to discuss the company operation, financial position, result, cash flow, and things that can affect their company. And also in China, the final statement must be consolidated, comparative, and reported in Chinese currency, that is renminbi. And annual financial report must be audited by CPA in China. And also companies listed on the capital market must control and involve external auditors. In our book, it stated that in China there are 6 accounting measurements. The first is their historical cost is the basis for valuing the tangible asset, and the revaluation is not permitted. The second is tangible assets are depreciated over their estimated useful life. Usually they use the straight line basis, but decreasing balance and unit production methods are also acceptable in China. The third is FIFO and averaging methods are acceptable costing methods, and inventories are recorded for declines and the obsolescence. The fourth is the acquired intangible assets are also recorded by the cost. The fifth is assets that have a limited life are amortized over their beneficial periods, and it also based on the pattern of consumption of these benefits. An intangible asset with an indefinite life is not amortized, but it is tested for impairment at least annually. In China, since land and many other industrial properties are owned by the state, companies in China that acquire land, use rights, and industrial property rights classify them as intangible assets. Assets are revalued when ownership changes, such as when state-owned companies are privatized. And also in China, a certified asset appraisal company or a CPA company determines the valuation the asset that already become an intangible asset. The last is research costs are expense, but development costs are capitalized if technology feasibility and cost recovery are determined. Now we move into the India accounting system. It was from 1947 to the late 1970s. Their economic had a socialist style planning, so it is coordinated by the central government and an import substitution industry. And their service sector has proven to be the most dynamic sector in India in recent years. So in that period of the recent years, the Indian telecommunication and their information technology was recorded developed very rapidly. But their future economic growth is constrained by inadequate infrastructure, convoluted bureaucracy, labor market rigidity, and also the corruption in India. And most of observers or researchers agree that further reforms and additional investment in infrastructure are needed to make India a leading economic player. So here all about regulation and implementation in India. There are 5 points. The first is there are two main sources of financial accounting standards are corporate law and accounting profession. The second is the bookkeeping must provide a true and fair value of the state of the company and must be kept on accrual basis with the accounting system double entry. The third is ICAI was founded in 1949. The ICAI regulates the accounting profession and they also responsible for develop their accounting and develop their auditing standards. The fourth is Accounting Standards Board must publish Indian accounting standards and their auditing and assurance standard board must publish auditing and assurance standards. The fifth is the regulatory body that oversees the function of the stock market is Securities and Exchange Board of India. So in India financial reporting, there are 4 points. The first is the financial statement consists of a 2-year balance sheet, income statement, cash flow statement, and accounting policies and records. The second is the companies in India are not listed on the capital market, only required to prepare parent company reports, but listed companies must prepare consolidated report and also the master reports. The third is Companies Act require the director's report to be attached to the financial statements. And the last is for companies listed on the capital market, they must also provide their interim financial result every 3 months. Okay, now is about India accounting measurement. There are a few points. The first one is fixed assets are valued based on historical cost or the fair value. The second is the depreciation is allocated systematically over the life of the asset. The third is the intangible assets are usually amortized for less than 10 years. The fourth is the research costs are charged as incurred, but for the development cost may be deferred if the technical feasibility of the product or process has been demonstrated. And for the cost recovery is reasonably certain. The fifth is their inventories are valued based on lower cost or net realizable value. The sixth is FIFO and averaging methods are acceptable cost flow method. The next is finance lease capitalized at fair market value and depreciated over the lease term. And the last is operating lease charged on a straight line basis over the lease term. So it's all about our group presentation. Let's discuss about question and answer in the Zoom meeting. Thank you.